Today we're going to begin covering Chapter 3. Chapter 3 is going to deal with the adjustment process. Now, we concluded Chapter 2 by giving you a view of the accounting cycle up to the point that we had covered. So we went from transaction analysis into the journal, posted to the ledger, prepared a trial balance, and then the financial statements. What's missing from that accounting cycle is the fact that not all accounts are fully adjusted at the end of the accounting period. And this results from the use of the accrual basis of accounting. So for example, the office supplies for Smart Touch, we started with 500. What if they use supplies during the year? If some of those supplies were used up, it may not be reflected on the trial balance. So therefore, adjusting entries are needed. The first thing we'd like to do is discuss Learning Objective 1. And this is our first module for Chapter 3, where we're going to differentiate between the cash and the accrual basis of accounting. What's the difference between the cash and the accrual basis? Well, the two approaches we know when we picked this up in the first chapter to account for business transactions, we can use a cash or an accrual basis. However, make sure that you're very clear that the accrual basis is what we must use for GAAP purposes. Generally accepted accounting principles require that we use the accrual basis. The cash basis, of course, could be used as long as we're not issuing financial statements to the public. The cash basis, of course, focuses on actual cash receipts and disbursements. Cash basis revenues are recognized when they're collected, and cash basis expenses are recognized whenever a payment is made. On the accrual basis, we recognize revenue and expenses when they are earned and incurred. So therefore, the recognition of revenues and expenses are not affected, or there's no impact of the timing of cash receipts and collections. Rather, revenues and expenses are recognized when the economic activities actually take place. So we recognize revenue when it is earned, when the service is provided, or when the goods are delivered, even if collection is at a later date. Expenses are recorded when they're incurred, when we actually consume economic resources, when we use up utilities, when we use up supplies. That's when we record the expense, even though we might pay the utility bill 15 days into the next month. So, perfect example of this accrual basis is interest. You may have an investment that accrues interest. You may not collect the interest until January 2nd of the next year, but at December 31st of this year, some interest has been earned. So we have to, using the accrual basis, we have to accrue additional interest. Expenses. Utilities are used up every day in a factory or in an office. However, December 31st comes along and you don't have the utility bill until maybe January 15th. You might note that your cell phone bills or any other utility bills that you have, usually the 15th of the month is kind of the cutoff on that, and that's when it's paid. So it's paid in the next year, it's collected in the next year, even though interest is earned or accrued as of December 31st for this year, and the utilities are expensed by December 31st of this year. So the accrual basis recognizes economic activity rather than simply cash receipts and payments. And as I said, the accrual basis is required by GAAP. The cash basis is not allowed. There are some exceptions. And the reason why the cash basis is not permitted is because it does not properly measure economic activity. Again, think about the fact that you have interest that's being earned, but even if you don't collect it until next year, it would only, a cash basis would only report the income in the year you collect, not the year that it's earned. Or if you have an expense. Expenses using utilities this year is when you should really recognize that expense, not necessarily when you pay it. So to compare cash basis versus accrual, under the cash basis, revenue is recognized when it's received. Expenses are recognized when it's paid. Not permitted under GAAP, with some exceptions, because it doesn't properly measure and recognize economic activity. And the timing of cash receipts and disbursements could be used to manipulate earnings. For example, this is a critical point, because if I have a fiscal year from January 1st to December 31st, and I wanted to show higher income, under the cash basis, I could collect in advance. So let's say I collect $1,000 in advance, and I provide the service. Next year. By collecting in advance, I show $1,000 of revenue, even though I didn't provide the service. Now, under the accrual basis, that would not be revenue. The accrual basis recognizes revenue when it's earned, so you would have to wait until you provided the service before you could recognize the revenue. Expenses are recognized when they're incurred, and again, it's required under GAAP. The reason why we require it is because it properly measures economic activity, and it is supported by the conceptual framework, by the time period concept, and the principles of revenue and expense recognition. And we're going to cover these in Learning Objective 2.